cat bonds are a way for insurers and reinsurers to transfer the risk of big disasters like hurricanes or earthquakes to the capital markets. They're structured using a special purpose vehicle, or SPV, which is like a middleman set up specifically for this bond. The SPV separates the financial transactions from the insurer's day-to-day operations. This is important because it protects investors if the insurer goes bankrupt. Here's how the structure works. The SPV issues the cat bonds to investors and collects their money, the principal. This principal gets placed in a super safe account, like U.S. Treasury bonds or similar low-risk investments. The insurer pays premiums to the SPV, which are used to pay interest to the investors. These premiums are like the cost of transferring the risk. If no major disaster happens during the bond's term, usually 3 to 5 years, investors get their principal back at the end. If a disaster does happen, part or all of the principal is used to pay the insurer for their losses. The whole point of this setup is to make sure the insurer has quick access to funds if disaster strikes, while giving investors a way to earn returns in exchange for taking on this risk. For a cat bond to pay out, something specific must happen, and that's defined in the bond's trigger mechanism. There are 4 main types of triggers. Indemnity trigger. This is based on the actual losses the insurer experiences. For example, if the insurer has $500 million in hurricane losses and the bond covers losses above $400 million, they'd get $100 million from the bond. This type aligns closely with the insurer's needs, but it can take longer to pay out because the losses need to be verified. Parametric trigger. This is based on measurable events, like wind speeds or earthquake magnitude. For example, if a hurricane reaches 150 miles per hour in a certain area, the bond pays out, no matter what the insurer's actual losses are. This is faster because it doesn't require loss verification, but it can create something called basis risk where the payout doesn't perfectly match the insurer's losses. Modeled loss trigger. This uses a computer model to estimate the losses from an event. Let's say there's an earthquake, and the model predicts $1 billion in losses for the region. If that crosses the bond's threshold, it pays out. It's faster than indemnity triggers, but relies on the accuracy of the model. Industry loss trigger. This is tied to the total losses reported for the insurance industry. For example, if industry-wide hurricane losses exceed $10 billion, the bond might pay out. This is helpful for diversifying risks, but can create a mismatch if the insurer's losses don't align with the industry average. Sometimes bonds combine these triggers, like mixing parametric and indemnity, to balance speed and accuracy. Let's simplify it. Investors buy the bond and give their money to the SPV. The SPV holds that money in a safe investment and collects premiums from the insurer. If no disaster happens, the SPV returns the money to investors, plus interest. If a disaster triggers the bond, the SPV uses the money to pay the insurer for their losses. For insurers, cat bonds provide extra financial protection against massive disasters. Instead of relying only on traditional reinsurers, they can tap into a bigger pool of capital. For investors, it's a way to earn high returns, and because these risks are uncorrelated with the stock market, it diversifies their portfolios. This structure ensures that both parties, insurers and investors, get what they need: quick payouts for the insurer if disaster strikes and predictable returns for investors.